Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Steen Jakobsen, Chief Investment Officer with Saxo Bank. We're going to discuss the hunt for inflation. Steen, it's great to have you with us. Welcome to Trade Talks.
Many thanks for having me.
All right, you got it. And the conversation around inflation is certainly reminiscent of the 1970s. Steen, where are you seeing the parallels?
I see the parallel in a number of ways. I think the 1970s is a very important analogy. We had the opening up to China. Now we're closing down. We had leaving the Bretton Woods. We had the gold link disappearing. We had big government, which we are of course having now with all the involvement of the government across the lower K of the economy. And most importantly, we have some bottleneck supply chain issues. So that's the 70s analogy, and it makes me really concerned because, think about it. This is interesting. We talk about transitory. The more the companies are convinced that this is transitory, the less they will invent in actually increasing the amount of supply that comes. Why would a shipper, why would a mining company, if they believe what Fed is saying that this is transitory, move the needle in terms of their investment? The Web will not. So it's going to be a very interesting 2 to 3 months on the inflation front.
Why are rates as low as they are when inflation's at 5%?
That's the question I get the most, and I think the answer is pretty easy. It's almost elementary, as Dr. Sherlock Holmes will say to Dr. Watson. And listen, the general account, which is the Treasury's excess issuance of debt, was sitting at $1.4 trillion. Now it's getting close to 500. So you have an injection of close to $1 trillion from the Treasury alone into the banking market. You've increased the M2 by 25%, but you have not increased the cap for the banks to take this deposit. So you have a reverse repo market close to 600 billion. That 600 billion needs to find a home, and they are forced through regulatory constraints to buy fixed income. So in other words, we've had somewhere in the neighborhood of 1.2, 1.4 trillion of liquidity coming to the market in the last 3 months. There's a rule of thumb in this market that says that 100 billion equates 10 basis points. In other words, if we have not had this liquidity addition to the market, we would have been 100 basis points higher than we are today. And that, in my opinion, is the reason. And that's why we probably will have a catch-up effect as we come into the later stages this year, when the general account has been run down, and that will have to happen by August, when we have the full impact of the QE tapering going on. I think there will be a dramatic one-off lift in both the rates and inflation as well.
Do you expect more fiscal support due to food and energy inflation?
Yeah, the food and energy is a real concern, in particular for people who are trying to deal with inequality in society. We know that the lower income brackets have a higher propensity to spend money on food. We know the emerging market countries have pretty much really two items they spend money on. One is energy, one is food. Both of them are up 50, 60%. So I think there is a huge amount of thinking and leverage and fiscal spend that needs to happen, both in the developed world, but certainly in the emerging market over the course of this year, because there are simply people right now around the world in the emerging market that cannot afford to live day by day. So we are ironically making inequality higher as we see the consequences of food and energy into the consumption patterns.
So with this backdrop, how is Saxo Bank recommending investors position their portfolio?
So we run a really long-term asset allocation, almost like what we call a 100-year allocation. But what we've done over the course of the last 9 months is to increase the amount of assets that is either negatively correlated or protects you against inflation. So as a cursory, I'll say that we have 5% in long volatility through ETFs. We have a 5% allocation to cryptocurrencies. We have inflation-linked bonds. We have commodities. We have gold. For the rest of the money, we run a classic approach of course, always being long equity, always being long a little bit of fixed income. But we are now reducing sort of the classic way of allocating to 50% of portfolio and buying all kinds of hedges on inflation, on the ability to withstand a correction in the market right now.
All right, Steen, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.